Good afternoon, I'm Catherine McQueen, and this afternoon I will be hosting Blue Whale's first ever live Q&A event for investors. I am joined today by Stephen Yiu, who is the CIO of Blue Whale Capital and lead manager of the LF Blue Whale Growth Fund. Thank you for joining us today, Stephen.
Thank you, Catherine.
There was a limited number of spots available and the team is humbled by the level of interest. Thank you all for your questions. We will try to answer as many as possible, but we may not be able to cover all of them in the time available. In regards to the outline for today, I have divided your questions across 5 subheadings so that the conversation is more fluid and easier to follow. These are market outlook, fund performance, investment process, stocks, and Blue Whale Capital. Please note that you may also submit questions live via the app's chat function during the first 30 minutes of the session. The last 20 minutes of the event will be dedicated to questions that we receive live. In case you'd like to review the Q&A session, a recording will be made available to all those that signed up to join us. Finally, I would like to remind viewers that this financial promotion is intended for UK residents only. With that, I'll start with the first topic for the afternoon, which tackles questions covering the market outlook. So, first question. Many commentators are predicting a crash in 2021. What is your view and what is your strategy to deal with this? That's from Nigel in Hazelmere.
Thank you, Catherine, for the question. I think maybe my first answer would be yes or no, depending on what you're looking at. If you're referring to some of the headline stocks, such as like GameStop, like Tesla, or even the recently IPO companies like Airbnb, DoorDash late last year, we definitely see that the fundamentals of those companies have been quite detached from the share price, which you can consider them in bubbly territory. But then if you're looking at our companies in the fund, about 30 names in the fund, that we do not feel that there's any company that are trading at an extreme valuation. So we feel that our holdings has been quite reasonably valued for the quality they are. And at the same time, if we do have some sort of bubbly territory in the holdings that we own, we would probably have done even better. And we have not. So we are very comfortable with the holdings in our fund. But then what can we do about this is about, I think the first and foremost is you avoid those companies that you feel they are not trading in line with the fundamentals, so avoid those stocks at all costs. But then secondly, if the market ended up giving you the opportunity, which means, let's say, if Tesla goes down by half tomorrow, and obviously a lot of stocks would be quite correlated with each other, and that would give us opportunity to invest more into the companies that we have in the fund at a cheaper valuation. So that's what we have got.
Thank you, Stephen. So we have another question, and that is, have you changed the portfolio composition in response to inflation fears, or is it just short-term noise? That's from Joshua in Beckenham.
Inflation has been quite a big topic since Q4 last year when we had the vaccine news that came out, and also at the same time Biden was elected in the US. And there's a lot of talks about reflation in the market and economy, etc. But then I think the first thing that people need to understand is where's inflation coming from in the next couple, probably 6 to 12 months from here. And it's not difficult to understand that when we are in a lockdown mode in terms of economy, and when you have a lot of restaurants and shops or even airlines disappearing or cutting their capacity, as soon as the restaurants and the airlines or holidaymaker open up for people to go travel and go to restaurants again, you would expect that the prices will be going up, right? Mm-hmm. Like in the past, you might be paying, let's say, 20 quid for main course. I'm sure like when you go to a nice restaurant again in a few months' time, you might be paying £25 for main course. And I think people would be willing to pay for that. And so the question is, so what is going to happen after this? So is this just like a one-off, which we feel from Blue Whale perspective, we feel this is a one-off inflation because it's people just being want to spend for a bit of time. But there's no evidence to date why after the economy reopen up again, that the inflation would be higher than the pre-COVID era. So before COVID, I think inflation has been quite manageable, about 2-ish% in the US or in the UK. And if you look at the wages, how much we get paid working, it hasn't been going up a lot neither. So in terms of I think there's a lot of argument about technology is helping the world to be more efficient. You can do more things with less, and hence inflation could remain quite low over the long period of time. So basically, the way that we see this is we don't disagree that will be short-term inflation in the market, and we're not worried about a short-term inflation blip. And we took the view that we don't feel that this is a sustainable high-level inflation over the medium term. Hence, we're not changing our strategy.
That's good to know. Thanks, Stephen. How do you envisage the ongoing rotation from growth into value will impact the LF Blue Whale Fund? That's a question from Jonathan in Kettering.
This is a very big topic it's been quite popular topic recently about value versus growth. And obviously, I think if you look at the last 10 years, company that can grow or have the ability to grow have done extremely well versus company that cannot grow, which they are typically in the value bucket. But I think the first thing for us to understand is what defines a high quality businesses. And one of the criteria that we need from a company is they have the ability to grow with new products, taking market share, expanding into new territory, etc. And also at the same time, pricing power. And if you can't do any of this, that means that it's unlikely that you can grow as a company to make more money. And to us, we would deem those companies as quite low quality businesses. And typically where the argument sits now is typically for those lower quality businesses or highly cyclical businesses, they would be trading at a very low PE multiple on a headline basis. So you're talking about the next 1 to 2 years, you have seen companies trading at maybe 10 times, 15 times versus company that might be trading at 20 to 25 times that can grow. But to us, like we would deem those companies as quite low quality businesses to start with, and we're not interested. So, but recently, I think we can't disagree with the market. There has been a bit of rotation that some allocators or some investors have been overly excited about. Maybe we should now be investing into airlines, into energy company, into oil and gas mining company, just because that there's some level of inflation. But that is not sustainable. So it doesn't change anything about the company being a high quality business. They will just go through cycles and cycles, and they will have some period of time they will make a lot of money. They will have some period of time they loses you a lot of money, and we're just not interested in that area of the market. So we would rather stay with companies that can grow, and they're high quality businesses, and they're making good monies or delivering good return for shareholders like us.